This is Money Made Simple, the financial podcast that keeps it simple and gets to the point.
This podcast contains personal opinions and is intended to provide educational information only. It doesn't relate to your particular financial situation or goals and is not financial advice or recommendations. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit Simplicity's website, simplicity.kiwi. Welcome back to Money Made Simple, brought to you by Simplicity. So today, we are going to tackle something that's on the minds of a lot of New Zealanders at the moment. It's a pretty tough world out there. There's the current wildfires that have been raging in LA. We've had a whole lot of weather events in New Zealand over the last couple of years. And, you know, insurance is something that people are worried whether they have enough, whether they should have it at all. So we thought that we would try and tackle it. This is going to be a two-part podcast. And recently at an industry event, Jenny and I actually ran into Mark Banicevich. Mark is from Partners Life and is an insurance expert. So we thought it would be a great opportunity to get Mark in to help us from a more expert point of view than us to explain a little bit more about insurance. So welcome, Mark. Thanks for coming in.
Thank you. I think it's a bit of a stretch to call me an expert, but it probably puts me in a position to explain things in a way that consumers can understand, because I have to be able to understand it as well. So thank you for having me.
No, you're very welcome. And again, just a caveat, we aren't affiliated or partnering with Partners Life. We are literally borrowing Mark's knowledge here to help explain in a bit more informed way than we can.
And I think also important to point out that we're not giving anybody advice here. We're just going to tell you about insurance and how it works, and recommend that you seek advice to get some real expertise in what's right for you when it comes to insurance.
Absolutely. Cool. So let's just dial back a bit and focus on you just for a minute. So tell us about yourself, your personal life, your career. What's interesting about Mark?
Oh, that's an interesting way to start. I suppose I have been with Partners Life now for 8 years. Prior to that, I worked at the Financial Markets Authority for 3.5 years in the intelligence area.
Wow.
I was a principal intelligence analyst, which was probably the best title I've ever had in my career.
Sounds like you're part of the CIA or something.
It did, didn't it? Yeah, I have a good story about that we'll save for another time. But prior to that, I started my career as an analyst. I did degrees in commerce and in law, and just found that I was good with numbers and spreadsheets, and that was the start of my career.
Cool.
And moving into Partners Life, I've been very fortunate to get away from spreadsheets and start talk to people more, which is far more enjoyable than looking at screens.
And what do you do for Partners Life?
There's two elements to my role. One, I do a lot of work with financial advice providers, so the companies that employ financial advisors, to help them understand what their legal obligations are and how to run their businesses and those sorts of things. And the other side of it is I do a lot of work with the industry. We are a member of the Financial Services Council, and I chair a couple of the committees in the Financial Services Council. I work with Financial Advice New Zealand and a number of the other bodies.
And have your own podcast, right?
I do have a podcast.
Fellow podcaster.
Yes, indeed, although it's probably not going to attract too much attention from our audience today. It's on governance, which is about how businesses are overseen and run, and who looks after shareholders and that kind of thing. I'm actually doing that for personal interest. It's something that really interests me, and I just started talking to people, and I'm up to about episode 83 or something, I think.
Wow. Oh, you've got quite a few more than us. Oh, well, we've got someone that knows a bit more about insurance than I do, and a fellow podcaster. What could go wrong? So let's look at the basics around Insurance 101 first. What does insurance mean, and why does anyone in New Zealand need it?
That's a really good place to start. I think the best way to answer this is to consider that there are some things that can happen in your life that can really trip you up financially. And, you know, most of us are not in a position where we have a large pool of cash that can help us if our house burns down, we crash our car, we get afflicted with some major health event and we can't work for 6 months. And what insurance is a large number of people pooling their money, so that if something goes wrong to one or two people, then the money comes out of that pool to put them back into the place that they were going to be in without it. And you'll hear the word indemnity. And what indemnity means is putting you back to where you were if that event didn't happen. Okay,
so covering you for your current lifestyle and finances if something happened to trip that up.
Yes, if you've got the right insurance cover, that's exactly what it's designed to do.
I think that's a really interesting point that you made around, say, the one or two, and it's a lot more, but say in 100 people, one or two have major events happen, and that pooled funding kind of helps get them back on their feet. So you're not actually thinking about insurance as paying your way for things that are going to happen. it's better if those things don't happen to you, right?
That is a really interesting thing about insurance. If you have an insurance policy through your entire life, and let's face it, you'll pay thousands of dollars in premiums over that time, the best possible outcome is for you never to have to claim that.
Right.
But what the premium has done is it's contributed money for other people that have had those bad events.
Yes.
So you don't get to the end of your 60 years of paying premium and say, I never claimed, can I have my money back? Because it's done its job. What you're really doing with an insurance policy is transferring the risk of things that could happen to you to a company to take that risk on your behalf.
Yes, and looking at those ratios of how many people it will happen to, and it might not be you. It's an interesting mindset to get out of in terms of trying to get the value out of your cover, rather than a better option is actually to not have to use it.
Yes, absolutely. You ideally don't want to claim, but it's there for you if you need to. That's
Yes.
the whole point of insurance. If you have an insurance policy, if something goes wrong, claim on it, get the money back, and we'll talk about claims, I'm sure, in a moment.
Awesome. Okay. On that note, looking at insurance, there are two main types, right?
Yeah, sure. So when we talk about these two main types, there are more types, but for the consumers, for us, it's the two main types we're most concerned about. One is insuring your stuff, your car, your house, the things in your house, those kinds of things, your boat if you're lucky enough to have one. The other one is to insure the financial things that can happen to you. So if you have a health event and you can't work, then your income's not coming in. If you were to die, what's happening to your family? Who's looking after your family? If you get diagnosed with a major health event, is there a lump sum of money to help you make modifications to your house if you need to, for example, or take some time off work? So they're the two main types. We call them general insurance, which is insuring your stuff, and the other one is personal risk or personal insurance, or most commonly life and health insurance is how we talk about it.
Okay.
One of the most important differences between those two is that a general insurance policy
covers like car and house and contents and whatnot. Yep.
Yeah, that covers you for usually for a year. You take a 1 year policy, and at the end of that year, you're actually taking out a new policy. So in some extreme cases, an insurance company can say, oh, well, yeah, you had your policy with us last year, but we're not going to give you a policy this year. We don't like your risk for some reason. The recent flooding and weather events, I think some houses have had that issue in New Zealand, but as you say, it's not my area. I don't know too much about it.
Yes, so Partners Life does not do the general insurance type stuff.
No, Partners Life does life and health insurance, and the main difference is that with life and health insurance, you buy a long-term policy, usually until at least age 65, and while you continue to pay for your policy, that policy is in place. The insurance company cannot take it away from you.
Can't say you're too risky now that you've had a heart attack or something like that.
Once they're on risk, they're on risk once
Okay.
you've got while you've paid the policy.
Cool. And in part 2 of our Insurance 101, we're going to go through the common types of different personal insurances. So we'll get to that later. In the meantime, let's quickly break down a list of really typical insurance jargon. So I think this is something that often turns consumers off, like the financial industry and funds industry, that simplicity is in. The insurance industry is full of it. And there's reasons for it, but let's break down a couple of those main terms.
Absolutely.
Okay, first, just because I think this is one that I hear the most, is premium. What is a premium?
Sure. As I said earlier, you pay a small amount each year to transfer your risk to a company in case something big happens. That small amount that you pay is called your premium. So the premium is the price you pay for the policy.
Okay, so it's not like getting something extra good. That's not that form of premium. It's a completely different meaning.
Yes, it is a different meaning. Yeah.
Okay, awesome. Short and sweet. Next one, policy holder, and related to that, the life insured and the beneficiary of your policy.
Sure, yes. The policyholder is the person who owns the policy, or the policy owner.
Okay.
The life insured, particularly, or assured, depending, there's a slight technical difference. That is the life that is covered in the policy. So it is actually possible for me to take a life insurance policy out on you. I can be the policy owner,
Yep.
and you'll be the life assured or the life insured.
Okay, so that would often be in a family scenario.
Yes.
And then the beneficiary, is that different?
It can be different. The beneficiary is the person that gets the money in the event of a claim.
Okay.
So often the beneficiary will be the policy owner or the policy holder. Take, for example, life insurance. You don't tend to want to pay the life assured if they die because
They're
they're dead. Often it'll go to the estate depending on how it's set up. But generally you want the money to go to your spouse, for example, or to your children, so they'll be the beneficiaries of the policy.
And that will be defined within
That's part of what you set up when you set up the policy.
Okay, cool. And how about underwriting? This is one that gets me and sounds scary and hard to understand.
It's a funny term because I think originally the way this term arose is in the early insurance contracts, there was a person that signed their name underneath the contractors who was saying, I'll take the risk on. And that's the underwriter. So it's called underwriting because they wrote their name underneath the other people in the contract. But what they're actually doing is they're asking you a bunch of questions to try to understand your risk so that they can price appropriately. Now, in life and health, you'll find this even when general insurance, when you call up about your car, they'll ask you questions like, where's your car parked? Have you got an alarm? Those sorts of things. So that's all to do with
underwriting applies to both general and personal.
All insurance, yeah. In life insurance, they tend to be quite large questionnaires where they're asking you with your medical history and, have you ever had a bad back or hurt your shoulder when you've come off a bike or something like that. Because if you've had those events in the past, they can increase your risk of making a claim on those things in future.
Which increases your premium, right?
It
Potentially.
can increase your premium, yeah. So that, another term that you'll get onto, you get exclusions and loadings. And when an insurance company underwrites you, they might carve out some of the risk and say, yeah, we'll give you cover, so we'll pay if something goes wrong. But these particular things, if they happen, we're not going to cover it. We're not going to pay out on those things.
Because they see that as too high risk? Would that usually be the reason?
And that's usually because something's already happened to you in the past. There's in fact 3 things they'll look at in personal insurance. One is your medical history. So if, for example, you've already had a heart attack, chances are an insurance company is not going to want to cover you for another heart attack because you're at a very high risk of recurrence. So personal health history. Another one is your occupation. Different occupations have much higher risk. If you're up trees cutting down branches, you're at much higher risk of a significant event happening that will stop you from working than you are if you're typing on a computer or having conversations the way that we are. So your premium will be higher for that reason. And the other one is pastimes. So if you have a lovely office job during the week and so you're fairly low risk, but you love base jumping on the weekends,
right, or jumping out of planes or
might
something.
say, we're not going to cover you for that. Or as an alternative, in some cases, they will do what's called loading, which just means they'll charge you a higher premium.
Oh, okay. So they might cover you. They might not see it as an exclusion, but it might...
They might load it instead by charging you. I say, look, we can offer you cover for that thing that you have, but if we're going to offer you cover, and we'll charge you twice the normal premium because it's that risky.
So it could get really expensive to insure yourself in that instance. Okay, cool. So we've just covered the exclusions and loading that I had here. How about a claim?
A claim, yes. This is the good and bad of insurance. This is what insurance is there for. If something goes wrong, now insurance is a contract. The insurance contract will say what it will cover you for. These are the things that you can claim on. And if one of those events happens to you, your claim is when you contact the insurance company, often through your advisor. If you're working with a financial advisor, they'll do this on your behalf. And they'll say, my client has had this thing happen to them. We'd like to claim some of the money on the policy. And that's when you'll get the payout of money. To reinstate you, to indemnify you to the position you were ideally.
Oh gosh, we just
word indemnity again.
Yes, yeah, we just got complex there. How about excess and wait periods?
An excess is very common in general insurance. It can happen in life insurance policies depending on the insurance company. Now, what that means is when you make a claim, let's say, for example, you crash your car and it's going to cost $5,000 to repair your car. You'll often have an excess of $500. So the insurance company will say, yep, we're going to pay the $5,000, but you pay the first $500.
And that's something that would help you lower the cost of your insurance by having an excess, right?
That's right. And often insurance companies will give you the option of increasing your excess. So you can say, well, rather than taking a $500 excess, I'll take a $1,000 excess because I know I can have $1,000 sitting in
for my emergency fund.
For my emergency fund.
Yeah.
And that will reduce your premium because if something small happens that's only going to cost $800, there's no point claiming it's less than that amount.
So they're taking on less risk.
So they take on less risk.
Insurance is all about risk, right?
Yeah, so that's your excess. Now, in the life insurance world, particularly around one form of insurance about replacing your income, one of the alternatives that can be used to reduce your premium as an alternative to an excess is what's called a wait period. Because that type of policy is essentially replacing your income. But with a wait period, you can say, okay, well, yes, we'll cover you, and this type of policy will cover your income until you're age 65, for example, if you have that type of policy. but they won't start paying you for the first 4 weeks or for the first 8 weeks or for the first 13 weeks. You've got to have an emergency fund to cover that. And so extending that wait period again can reduce your premium.
Okay.
Because
So
if you're off work for 12 weeks.
So a wait period is the amount of time that you've specified in your contract that you have to wait until you get your claim paid out.
Yes, and these are only for claims that are for monthly payments. They're not for the lump sums.
Okay, cool. I think that is kind of the really common jargon covered.
Yes.
And we're going to wrap it up there because
Okay.
I think we've...
That's enough for one day.
Yeah, exactly. 101 of what insurance is and what it means and all that jargon.
I think just a final word would be to say, as you've established, insurance is quite a complex area. It's really important to understand generally what it is and why you should have it, because things can go wrong and you may not have $100,000 in your bank account to cover these costs. It is really important to seek advice. So find a financial advisor, ask some questions of the advisor, ask about some previous clients so you can get a feel for whether it's the sort of person you want to work with. Find an advisor you're really comfortable with.
So you don't have to stick with the person that you first ask, right?
You don't have to stick with the person you first ask. No, you are the customer here. Choose the person that really resonates with you and then let them walk you through this minefield and give you the explanation of what you should have and talk to them about the right balance. It's very difficult to do this kind of thing yourself.
Yes, and we are in no way advisors, so make sure that you talk to someone
Neither
yourself.
of us are qualified to give financial advice.
No,
Yes.
not at all. Awesome. So next time we are going to do a little bit of a deeper dive, still staying pretty top level, but the different types of insurance that people tend to get. And tips on how to manage your costs versus your benefits of taking out insurance.
Cool.
Well, thank you, Mark, and look forward to chatting with you again next time.
Thanks, Liv. I look forward to it.
The information provided and opinions expressed in this podcast are intended for general information only and not personalised to you. These materials do not take into account your particular financial situation or goals and are not financial advice or a recommendation. This podcast is not intended to convey any guarantees as to the future performance of any of the investment products, asset classes, or capital markets mentioned. Past performance is no guarantee of future performance. Information is current at the time of posting and subject to change without notice. Simplicity New Zealand Limited is the issuer of the Simplicity KiwiSaver scheme and investment funds. For product disclosure statements, please visit our website simplicity.kiwi.